Hi, welcome back to Expanded. Let me talk to you today a little bit in privacy about Bitcoin and why I think it's not going to be the next holy grail. So shall we? Let's start first by discussing what did we have before the crypto mania. Let's talk about the traditional financial system, which we had and have still. DeFi we will discuss later on. Here we have a marketplace symbolized by hard drives and computers. Right now, let's just say that on the left side, we have some market participants, person 1, person 2, and company 1, that is a corporation, and company 2, that happens to be a bankers union. They all come to the market where they would like to interact. But can they? Well, we have some gatekeepers. That's the first criticism of classical financial market. And these gatekeepers, you see what I did there? You can imagine them as banks, insurance companies, brokerage houses, and so they insert themselves in the middle of every transaction that takes place or could take place, and they dictate some requirements, some rules, out of which comes the next criticized point, which is the proprietary aspect of data. Given the nature how these gatekeepers operate, they collect a lot of data, and let's just say that this data is represented by the bankers union. They have access to all this data, and they utilize data to further their business and other political interests. So they treat this data as their own property. So that's another criticism. The data is proprietary and is used for business purposes. The next criticism is security and stability. What we can see are these ghostbusters on the bottom of the screen. Let's take the first two, the hacker and the thief. They are actually interested in attacking our bankers union to extract data information, and they can end up also stealing monetary assets. When we have an insider, he has an upper hand because he has information that these two don't have and these market participants don't have. So let's call him an insider for the time being. He usually causes greater damage to our bankers union than these first two. Whom do we have here on the right side? Well, the regulator. I put him alongside these other actors, but actually he is a special ghostbuster right here, because he is the only one out of the 4 ghostbusters who actually can create some real damage and can threaten the existence of our bankers union. He is imposing all kinds of rules and requirements. He is supervising the bankers union, therefore potentially has similar advantage as the insider. And if he doesn't see what he pleases, he can decide on what consequences does the bankers union have to bear. And it does not apply specifically only to bankers union. I'm using it as an example, but the regulator regulates all kinds of financial aspects of a traditional financial market, insurance companies, credit institutions, banks, whatnot. Therefore, he has an upper hand, and there is a closer cooperation between the bankers union and the regulator here. These actors all represent some kind of an issue, the first 3, and their actions usually trigger the regulator to increase stricter requirements on the business behavior of the bankers union, because the regulator actually is one of the ghostbusters responsible to represent the interest of all the market participants, right? So what this actor does, the regulator is enforcing all kinds of rules that make sure the bankers union and all these gatekeepers do not bend the rules in their own favor. But at some points in time, the very market participants whose interests are represented by this ghostbuster, by the regulator, are the ones who criticize the regulator. First, that it's not acting sufficiently fast enough. Second, that it has preferential treatment of some of the gatekeepers or some of the banker unions. And third, that is misappropriating or not handling financial assets in a very well handled manner. So let's move on. The next criticism of a financial system, a traditional one, is the anonymity, actually the lack of it. What am I talking about? Well, you can imagine every market participant who enters the gatekeeper will undergo some scrutiny, will have to disclose all kinds of information before all kinds of loans, insurance policies or investment products are being granted by the bankers union, by actually the banks or the insurance companies themselves. So this scrutiny actually ends up market participants submitting quite a lot of personal and all kinds of behavioral information that's being stored and is being treated, as we earlier mentioned, proprietary information, as private property of the bankers union. And on top of that, this information can be readily accessed on request of a regulator, for example, or maybe the police force. So that's a criticism that we might address later. And the last, or the one before the last criticism, is addressed towards the centralized control of power, which means the gatekeepers, the bankers union, and potentially the regulator are actors in this market who dictate how the music plays. And on the left side, we have these participants who will have to dance to the music. And there is no other alternative. Let's have a look at Gozer here. You see what I did there? So let's say, besides the bankers union and besides the lending banks, we have Gozer, who is in this equation symbolic representation of IMF or the European Central Bank, national bank of some sort, who can decide, yeah, I'm in control of this currency, and I decide that right now we will print some more money. And if all these participants on the left side have some sort of cash, after we started printing money, let's say we printed another 2000 units, now we have all in total 2800, and these 2800 units of currency must have actually the same purchasing power as the previously existing 800 which these three market participants had. So right now we have 2800 could buy exactly the same amount of goods than earlier these 800 had. But this 2000 is not redistributed equally between the market participants, no. It's usually designated to governmental spending, all kinds of projects that these guys up here, or this regulator here in the right bottom corner, deems to be fit. So that's another great criticism and usually big argument towards cryptocurrency and decentralized finance. Let's continue. Fees and commissions. Well, what can we say about them? Let's have a look. All of these participants will actually end up paying some fees that are collected by the gatekeeper, which are passed on to the banker union, let's say, which keeps some of it and passes on some of it to the regulator. Now, what's the problem here? Well, it's criticized that due to the complexity of this entire market, this entire system, there is a lot of costs involved, especially on the supervisory side, and the lack of transparency here at the bankers union side gives them an advantage of charging fees that might be higher than necessary. So again, market participants on the left side came saying fees and commissions are too high. We don't like that. Alright, let's talk a little bit about crypto. After 2016, a real big boom of cryptocurrencies saw its emergence. Has to do with Ethereum platform, which I will address at the end of this video. And now I'm actually going to build this thesis based on the developments that we see since 2016. I'm not going back as far as 2009, where Bitcoin was actually founded, so bear with me. The Stay Puft Marshmallow Man represents actually a computer algorithm, okay? What you see here is another network. This computer here, which has no lock, will be person 1. This computer also has no lock. Let's call it person 2. This computer has no lock, but let's call it company 1. And these computers are special. This one here is gonna be server 1. Server 2 is the left one. This one on the bottom left is gonna be a miner. Never mind that. It's a different kind of market participant who is contributing to the creation of cryptocurrency. Something like the national bank printing money. And here we have server number 3. Okay. As you can see, it's some kind of rectangular shaped network. It's a market that we can also call a sandbox, right? Let me explain. We see our algorithm that's controlling this market, this little sandbox in which it lives. It's going to be the decision mechanism which decides how much what costs, how much new cryptocurrencies will get printed, when, under what circumstances. It's gonna also decide how fast it's gonna be distributed, and what we will start looking at is the same aspects but in the crypto world. So, do we have gatekeepers? Well, we do, but as you can see, they are not in the middle, they are outside. Why? Because these guys cannot enter the sandbox. Let's say this one here on the left is an insurance company. What it is actually guarding here, or looking at and analyzing and trying to learn from, is a decentralized financial product called insurance. This one on the right side, so that was an insurance company. This one is a bank, and this guy is watching over a peer-to-peer lending application which is running in this crypto world. And the third one, who is going to be a trading company, let's call him merchant trader. And that's an algorithm which allows holders, participants like person 2, person 1 or company 1 to engage in all kinds of exchange of cryptocurrencies, literally trading them. And then these gatekeepers are also observing the center, which is going to be the essence of this ecosystem, is the cryptocurrency, which is the monetary means of exchanging services, either buying insurance, paying for it, providing lending services, or borrowing money, or just simply trading one currency for the other. And there are XYZ other services which we will not discuss right now, or at least we won't go into too much detail of them, maybe in frames of another video. What we can see here, this sandbox, this ecosystem, is what I would like to use as an explanation for DeFi, so decentralized finance. So we can see that the gatekeepers are outside. They are not really influencing the system right now, but they are observing and learning from it, right? Then we have the proprietary data. Well, we can say that the biggest argument for cryptocurrencies was that everyone should see data. It's no longer hidden. All the transactions are open in a so-called database they call an open ledger, which can be browsed, searched by anyone. Well, that's true on one hand. On the other hand, this database shows a sequence of all kinds of alphanumeric codes. A common user will not be able to use that data, will not be the visor. So I would still say that data is still proprietary and is actually guarded and kept by all these little startup companies which decide to use this platform, this cryptocurrency, to build their little lending applications, trading platforms, or insurance platforms on it. They will have their own databases, they will have their own secrecy, and just like on the previous occasion when we were talking about traditional finance, well, they are actually doing the same thing, just in this sandbox. So data is still proprietary as long as I am concerned, but that's a personal opinion. Anyways, they claim it's no longer proprietary, whatever. What about security? Well, security is a big question. Let's take our 4 actors again. It's the 4 Ghostbusters. And let's say they attacked server number 1. What they did is the hacker stole personal information of users who were using server 1. Instead of server 1, server 2, and server 3, we can probably call them exchanges. It will help. Exchanges as in stock exchange, exchanging currencies, and these exchanges would work just like a real stock exchange, right? So let's use that as a definition for the moment. So all these participants, now company 1 here in the background, person 1 and person 2, they would be able to come to an exchange and transact with each other. These exchanges are also private startup companies, and they have their own servers which are physically located somewhere. So theoretically a hacker could attack one of those servers. So let's say hacker 1 here has brought the exchange to its knees. Then we have our thief who does not have to literally attack our server here or the exchange, but he might be a scammer who is after access codes. Well, at this point we would have to explain what kind of codes we mean by that. Every market participant would have to create a wallet, a virtual wallet, which is not much different from any application where we would have to register, and after registration we obtain a public and a private key. These are again just codes. The public key is used to interact with these participants in the sandbox, and the private key is the one that the user is not supposed to share. That's just like a real wallet. So with this private key lost or stolen, it's just like stealing someone's purse. So we can see that these 2 actors are still in the equation, regardless that we are now in this highly fancy and advanced crypto world. And we have an insider. This is a different consideration that I had. It's again a personal opinion here. Here the insider is someone who understands how the technology works, or someone who was developing it. and is able to exploit some bugs which were not yet discovered or at least not yet fixed, and potentially can act as a hacker or as a thief. So, in my opinion, this category of an actor is probably a higher threat than the first two. And what else do we have here? Oops, there is no regulator. How come? Well, we are in a sandbox. It's completely governed by an algorithm, and there are some actors in the market, some exchanges, and it's self-governing. There is no regulatory body here. There is no one who could step in on behalf of person 1, person 2, or company 1, company 2. There's no one who can impose any restrictions, at least at this level of abstraction, which is a simplified one. Well, we managed to keep all the risks, and the little reward that we had out of regulations we lost here. That's an aspect of security that falls away, and that's a big loss. So that's why usually cryptocurrencies, even the ones which are rated by rating agencies, never have a better rating than C, which is sub-investment grade. Just in your case, I mean, if you are in the finance world, you would know or have heard maybe Standard & Poor's rating grade. A company which has AAA rating is considered to be of best credit quality. So in other words, is expected to always pay back. And the worse the rating gets, it goes through AA, triple B, double B, single B, C. Yeah, triple B is the last rating grade, which is still investment grade. And then we have double B, single B, and then C. And these cryptocurrencies are C rating, okay? Don't forget that before you get into crypto trading. Given all that, and having no one who acts on behalf of participants in this market, well, that's a fairly bad situation, right? Because let's take an insider, for example, who designed this ecosystem, let's say who designed the lending platform, might have introduced some bugs, or might have not noticed but later discovered a bug which is already in operation, and he can exploit it. So can the hacker, and so can the thief. Some anonymity, that's another aspect, right? Earlier we said in traditional finance anonymity is not an option. Well, in crypto world, the very first time when Bitcoin was introduced, there were no means to identify who is the owner of which coin. Again, this distributed ledger, the open database I mentioned earlier, shows all the codes that represent all the transactions, and one can see how much bitcoins were sold, bought, and sent from which account to what account. There is just simply no way to assign the account to any physical person or company. So that was the secrecy and anonymity at the beginning. Right now we have to again say that this aspect is falling away as governments and regulators are stepping in and actually setting up some measures. So as we said, all these gatekeepers are outside the sandbox, but they are standing there, right? So imagine person 2 would like to buy some Bitcoin here on exchange number 3 or server number 3. Server is technical, exchange is, abstract. So let's use the abstraction of exchanges. So person 2 would like to actually come to exchange, but this exchange now has the requirement from the gatekeepers, from the outside world, from the real economy, whereby the regulator says you will actually have to identify your customers and keep information about whose account is what and what they buy and what they sell. And this information will have to be readily available if we need it. Well, what did we just have here? We just lost all the anonymity. Everyone who manages to purchase and sell cryptocurrency, let's say in this case Bitcoin, through other means than an exchange, could probably still preserve his anonymity, but a fairly layman person who does not understand too much about programming, the crypto world, would not really undergo that hustle, would rather go to an exchange directly, where the steps of purchasing and selling cryptocurrencies is a very easy process, and therefore those people will most probably always be identified. Once that happens, these persons, if that public key transacts anywhere in this ecosystem, in this sandbox, it's gonna be suddenly trackable, because these alphanumeric codes, now we know how to assign them. And every transaction that that person did also in the past will suddenly be visible. And usually, once that person is selling consequently his crypto holdings, converting them to fiat or otherwise regular currency, the regulator or even these exchanges are suddenly able to calculate what kind of earnings did this person produce. And suddenly, he is liable for capital gain tax. By example, if he ever purchased bitcoins in the worth of $100 and by today his bitcoin is worth let's say $3,000 when he sold them, the difference between these two is the tax base, from which let's say that capital gain tax is at around 15%, $454 capital gain tax, and he is effectively left with $2,466. Yeah, from 2,900 to 2,466, and this $454 is the gain that the regulator, that the government pocket in for doing exactly nothing, for undertaking no risks of any kind. Well, of course, this person too might has as well just lost all his money. Let's say he bought another currency, let's call it for example Bitcoin, $100 worth, and now it's worth $3, and unfortunately he has to redeem, for whatever reasons he needs these $3, so he sold, and because the difference between the two is minus $97, he is not liable for taxes, but he underwent some risks, right? He risked his own capital and he lost. But of course the government, which earlier collected this $454, of course does not care about this event, and he's not gonna get any money back. In some jurisdictions, of course, gains and losses can be offset even across different accounting periods, but for the sake of simplicity I would assume that it's not possible, and should this investor have only generated losses, there is no way he can recover them in subsequent periods. So that sucks, but this is what anonymity is all about, and you can see that currently there is not much of it left, and everyone who still is transacting anonymously is basically moving just within this sandbox, must have used maybe Bitcoin ATMs to purchase Bitcoins, and is basically selling his Bitcoins to other market participants who are willing to accept Bitcoin payments and who potentially were identified by an exchange and potentially would be able to disclose information on their business counterparts. So that's also not very anonymous anymore. Anyways, as anonymity is concerned, we are basically moving within this sandbox. Once someone needs to get out, there will be know your customer process, which he will be subjected to. He will have to register, open an account with a personal ID that will be verified, and so much about anonymity. If someone is trying to enter the sandbox nowadays, it's very difficult to avoid this KYC process. We usually would go through an exchange. All exchanges nowadays require KYC, so by default the person loses anonymity. So much about the advantage of anonymity. It's decentralized. Well, yes, it's true. This network is really decentralized, just for the fact that these actors right here attack exchange number one does not mean that the price of Bitcoin will be anyhow impact. I mean, yes, theoretically all these other participants in the market will be suddenly afraid and could decide that they want to sell their Bitcoins, and suddenly there will be more Bitcoins sold than purchased, and that oversupply of Bitcoins will drive the price down. And that's a secondary effect, but if we abstract from it and we assume that all these other participants are fairly convinced that their exchange is stable and is not gonna be hacked, is not gonna be attacked, and this was a single incident which was potentially even caused by deficiencies of the company running that exchange, then they would probably decide to keep their Bitcoins, and then we should not see too much fluctuation of prices of Bitcoin. Therefore, Bitcoins could be further on traded between the remaining market participants smoothly. Therefore, there is no systemic danger. The current economy is sometimes criticized that some banks are too big to fail. We heard since Lehman's bankruptcy in 2008, and this can be basically avoided by a sandbox crypto economy like that. So the insurance product prices and premiums will be still calculated the same way as before the attack. Well, again, I mean, trading with currencies might be a little bit influenced by current sentiment reacting to this hack attack, but lending rates should remain stable. That's the decentralized aspect of, or the advantage of having a decentralized ecosystem. Another thing is, well, besides the algorithm itself, no single exchange or market participant, the gatekeepers, or nor any regulator, no central bank can decide that they will start printing new Bitcoins. Just the pre-described or the pre-programmed rules of the algorithm decide when and how much Bitcoins are gonna be mined or printed, for that matter. So no one can actually manipulate it, is the intended advantage here, and no one has control over it, so that's probably another thing to mention. Let's see. Another argument is again coming back to fees and commissions, and that's a very small argument here, but hear me out. People say trading internationally with Bitcoin is so much cheaper and so much faster. Yes, it's possible. Okay, let's agree to that. However, if you heard about SEPA payments Europe-wide, that's pretty much an argument against Bitcoin. A SEPA payment requires the sending and the receiving bank to charge absolutely no commissions, no fees, and the transaction has to be concluded within 1 business day. So it's already pretty good. It's almost like Bitcoin. I mean, maybe the latency is still 1 day, okay, we agree to that. But we will also have to mention that the newest EU regulations are aiming for an even higher transaction speed. So I'm not really sure if this instant transaction speed would be still a valid argument in the future. And let's have a look at the fees. How are they constructed and what kind of fees do we have in such a sandbox ecosystem? Well, first of all, every time some cryptocurrency is sold, the person who is initiating the transaction has to pay some fee. And this fee goes back to the central pot and is going to be used to perform some actions. And again, it's decided by the algorithm. Usually, those fees are called gas fees, from the metaphor of burning gas money. Well, here allowing this ecosystem to work are operating servers that produce a lot of heat, consume a lot of electricity, a lot of power, and the gas money is basically a synonym for that power that's being consumed. Although the gas price in this sandbox ecosystem could be fairly disjoint from what energy costs would be. Yeah, then we have those actors which we earlier already identified as miners. What they are doing is calculating complicated algorithms, and once they solve a little algorithm, a little problem, they get rewarded by receiving points. Okay, so these miners are the ones who are generating the new Bitcoin. Every time they complete a complicated calculation, they generate a new Bitcoin. Every 10 minutes, as they say, there is 12.5 new Bitcoins distributed among the miners who solved the problem. So that's how the algorithm allocates new Bitcoins to the miners. And besides the miners, there are also some other actors who perform similar calculations, and those calculations just help in coding and encrypting all the transactions that happen in this sandbox. And of course, for performing this encryption, they will be rewarded the gas money, in simple layman's terms. Then we have, of course, these merchant traders, the lending apps, and the insurance product providers, from which I would say I have experience with the trader merchant apps. And in comparison to traditional trading companies, I would say that their fees are rather high. So I would not argue that fees are that much lower. Lending is a different story. There the usual complaints are the rather low risk weights and the rather low interest rates that very risky borrowers are being charged. There is some potential mispricing issue here with the loans. Of course, it's easy to assume that if a simple algorithm is supposed to serve everything and there is a lending app that has no one who performs the regulatory rule, that algorithm runs wild, one could potentially take advantage of it. Just think about that. All these actors we have here, the hacker, the thief, the insider, are continuously trying their best to improve at gaining the system. But besides that algorithm that was invented by someone somewhere at the initiation phase, there is not really anyone who is trying to improve the safety and the performance of that system. Or if there are some people, it's actually all these actors collectively have to all agree before any changes are undertaken. Now you can imagine, it's just like a homeowners union, where it's enough that a few people have different opinions and no agreement is being made. So imagine that the hacker and the thief only has to have a little head gain on all these actors who can't really agree on how to improve and amend the algorithm, and that's the problem. These guys are tirelessly working against this algorithm, and there is no one like we used to have in the traditional finance who is actively convincing and motivating this algorithm to introduce measures against these hackers, who is actively fighting for and is on the side of these market participants. It's their own responsibility to agree and to take action, and of course also to verify everything and discover mistakes. So in such a sandbox ecosystem, the difference in comparison to the traditional financial setup is that responsibilities are shifted around. You still have the same risks, you should still fulfill the same roles, but they are no longer performed by a regulator within the sandbox. Of course, every transaction across the borders of the sandbox are guarded by our gatekeepers, and we always have a KYC process, so fraud is much more difficult to perform, but within that sandbox, whatever happens is actually not safeguarded. Therefore, in my personal opinion, everyone who is in this sandbox would have to be a professional and should not be a layman investor. Yep. I will use the problem size analysis. What we see on the left side is the current economy, and in this bar chart, let's start on the bottom, 20% is the relative problem size. Of course, everything adds up to 100%, and we use the real economy as a benchmark from which we derive what the crypto problem set looks like, or the problem size looks like, and what adjustments do we expect in both the real economy and the crypto world. We have gatekeepers, which represent almost 20% of the problem. We already discussed these gatekeepers are the ones who impose arbitrary rules and stand in between market participants' transactions. We have the proprietary data, which is an issue. It gives an advantage to the gatekeepers who treat it as property and gains a competitive advantage using this data. We have a small problem of security, which is in the current economy rather well handled. There are repercussions. That's why this problem is rather small in comparison to the previous ones. Anonymity is a bigger issue. Well, that's a topic which is very debatable. Why should we stay anonymous, and is it really necessary if we have nothing to hide? That's not for me to decide. Let's just take this argument as it's being argued in favor of the crypto world just now. Then we have the power and control, which is again in the hands of Gozer. So the central banks, the regulators, and they sometimes misuse it, don't act in the best interest of the public, is the argument here. And as you can see, this problem also represents approximately 20%, so it's quite a big chunk. Fees arguably are quite high, so we left here a big chunk as well. It's a sizable problem. And we have a last chunk, which is reality check. It's a rather small problem. Let me define what it actually stands for. It's the direct connection with the real economy. So everything that two market participants do, they buy, they sell, they hedge, has to do with something that exists in the real economy. It's directly linked to the real world, and that's the reality check. If we move to the current crypto situation, we can see that total problem size is smaller. That's by design so. These are the claims of the crypto advocate, but let's then again compare. So we say that there is less gatekeepers, we still have them. The exchanges are there, the know your customer process is still there. If one wants to trade cryptocurrencies on an exchange, they have to still adhere to the rules of that exchange, but they represent a lesser problem, as it seems. The data is still proprietary because of the know your customer process. If person 1 and person 2 want to interact, they don't necessarily know too much about each other. So the information is again disproportionate. The exchanges have them, they don't pass it on directly to the market participants. So the data can be considered still to some extent proprietary. Let's use a very simple example here. Person 2 might be a notorious borrower who is using the same platform to borrow money, and he's defaulting. And for some reason the exchange did not prevent this person or was gamed by this person and could continuously keep borrowing. As long as person 1 is not able to figure this information out, his funds might be redirected to person 2, and thereby person 2 is actually stealing money from person 1, stealing crypto assets. For that reason, I still think that proprietorship of data is still a problem. The only difference here, as it seems, it's a smaller problem in the crypto world than in the real economy, but the only difference between the two that I see is who are the participants who keep this data private. Then we have the question of security, which is definitely a bigger one in the crypto world. We just went through some examples. We know that there are actors who are constantly trying to game the system, and there is unfortunately no actors who would be constantly trying to fight back against them. That's a big issue. That's why security is here a problem. Anonymity, since the KYC process is introduced and more enforced, it's a question of why is it even necessary to be anonymous. But okay, let's say it's still easier to be anonymous in the crypto world. Then we have the power of control, so that's a fairly small problem in the crypto world, and fees are still claimed to be lower in the crypto world, although that's probably fairly subjective, depends on the basis of comparison. And we have a reality check component where we can see that the crypto world recently, probably more so, but in the past had very little to do with the real economy and the real world. Why is that a problem, you ask? Well, imagine if the value of this cryptocurrency is basically only driven by demand and supply, how many people do desperately want to buy it or desperately want to sell it? Demand is higher, price goes up. If supply is higher, price goes down. And let's say everything looks dandy in our crypto sandbox, but in the real economy, I need to pay rent, buy groceries, pay for my children's education, for example, and all my assets are in this crypto world. Well, I would have to start redeeming them, right? Because living under the assumptions that is still gonna be holding true in the future, I will not be able to pay my rent with Bitcoin. I would probably, by now it's possible to buy groceries with Bitcoin somewhere, but unfortunately that's not an option for everyone. So having these Bitcoins and using them as money, as a means of transaction, is not gonna be possible. I would always have to sell the Bitcoins first. So if there is a real economic crisis, and then the Bitcoin's price will fall as a consequence of something that happens in the real economy. On the other hand, something else happens in the Bitcoin world. Say another hack attack, let's say another innovation, some developer discovered a new functionality that's gonna be added to the algorithm, Bitcoin price rises. What effect does it have on the real economy? Nothing, zero. It's very disconnected from reality. That's why reality check problem is so high. Now we moved on. We are comparing the current economy with the adjusted economy. That is what the banks, insurance companies, regulators, they are learning from what the crypto world did, potentially, right? Yeah. And they are trying to adjust themselves accordingly. Possibly, gatekeeping might go down. It's possible that proprietary ownership of data might go down. We already do have financial institutions using blockchain for various applications, usually cost-saving and effort-reducing applications. But the indirect consequence would be probably also that data will be a little bit more democratized. We see that security will probably improve somewhat. I guess this could be the result of learning from cryptography. Now, the anonymity aspect did not seem to improve here. The subject of control also did not change by much, but potentially there will be a little bit of a decrease in control. And there is a smaller problem of fees, because most probably what will happen is a negative consequence of all these developers and all these crypto enthusiasts is they showed how we can automate things, and they will be automated. So every human actor that was compensated here in this fees category can be replaced by some automation, will possibly translate to savings, potentially also translating to lower fees. So that's what is meant behind this lower fee. And it seems like reality check is probably the same issue, basically a very small problem here. We had combined problem size of 100%, which seems to drop down to 81. How about the adjusted crypto? If we compare current with the adjusted expectations, we can see there will be probably an increase in gatekeepers, possibly more obstructions, checks and balances. We still seem to have the same height of data being proprietary. As you can see, these blocks here do not differ. Security, as it seems, has declined, and here the argument as to why this is happening could be the fact that pressure for automation and the pressure for increased efficiency, making things more efficient, cheaper, faster, otherwise it's not going to be able to compete with the traditional finance solutions. This compromised security is basically a trade-off due to increase in performance, which is probably going to be temporary until all the bugs are fixed, but it seems most like in the future we would have a potential increase in security issues. Then we have anonymity. As you can see, the problem has increased. Why that might be? Well, we already mentioned KYC process. Everyone who was interacted with and the counterparty, the other side of the trade, is actually an exchange member, could be directly contacted for further information about their parties they are doing trades with. So this is how police forces and government, or just simply the exchange itself, could actually acquire additional information without the direct involvement of the party who is trying to keep their anonymity. That's to be considered as well. Now that we can backtrack and trace transactions of KYC customers, even if those trading partners never transacted on exchanges, this could lead to a compromisation of their anonymity. Then we have control. We seem to have an increased problem because of the ever-increasing interest of governments and regulators fighting crime and the KYC process and tracking customers. Then we have fees, and as a consequence of increased controls, increased performances that led to the increase in the security gap, we will also have increase in fees. And on top of that, it seems like the reality check has decreased. This is still a very big problem, but the decrease is probably coming from the fact that we are going to see products developed and invented that actually tie back to the real economy, whereby the instruments' performance themselves would somehow contribute to the real economy. But honestly, that's just a speculation. I guess it's yet to be seen. I don't know if there is any product that can be classified as a reality check problem reducing DeFi product. And we have just ventured to the wealth distribution highway, which is a concept which I came up with. Let's have a look at what do we have on the left side. These are the Bitcoin advocates, and what they expect is a wealth distribution that, starting with them, the community that's fed up with all the regulations, all the money printing, the centralized data, and the fees and costs of transactions, and therefore they develop some cryptocurrency called Bitcoin, perfected it, and it's going to be introduced in all kinds of little applications, online platforms, websites that have to be programmed, developed. They will become startups, they will be fundraising for money, so there will be a bunch of early investors, angel investors who would support this endeavor, and once they are ready, they would be able to basically backward confirm the validity of their claims by seeing Bitcoin treated seriously by financial institutions, corporates and companies interacting in Bitcoin, and in the market, in the stock exchange. If we would see, for example, Bitcoin futures and all kinds of derivatives and indexes that are based on Bitcoin, that's to confirm that they are successful and that these Bitcoins are gonna be used in the economy, and as they will potentially substitute fiat money, they will have some function of preservation of value, and they will potentially also rise in value, and therefore it will make them, this initial bunch, very rich. So they defied the traditional financial system by coming up with a much more streamlined solution, and it's more effective in all kinds of ways, and it's a means of exchange suddenly, and Bitcoins are being traded on the stock exchange, and everyone is buying, selling with Bitcoins. Yep, that's what the Bitcoin advocates say it's gonna be the future. Now let's have a look at what history says, how traditional finance evolved. At the very beginnings, we had big players who decided that in order to be able to reliably transact between each other, they need a market. They would probably need an exchange. So that's what they set up. There is a physical location, or there was, where people met to buy things, sell things, exchange things for money, and then again use money to purchase other goods. Later this became electronic, and now we have electronic exchanges where you can trade all kinds of financial products. And yeah, as these exchanges emerged, suddenly banks also got very interested. They started trading on the interbank market between each other, and as they discovered this is really very profitable, we basically collect deposits of customers, pay them 0 to nothing on the deposits, and in the intermarket we make this and this much money. We can also lend, we make a cut. What else can we do? Well, we can involve corporates. We can offer them some products. Let's say our balances are limited. We are only able to issue as much loans as our deposits are covering. So why don't we separate parts of our balances, sell them off to companies who are now becoming our investors, and we free up some balances and we can continue lending? Or why don't we package some of the instruments which we have very good access to through these exchanges, and why don't we sell it to them for a fee? And when that was already not enough, when they wanted more, they saw that there are these extremely wealthy individuals, they are also customers of the bank, and so these also got packages of services who was also able to then invest indirectly through these commissioned products in the stock exchange, of course provided by these banks. And under these extremely wealthy individuals we have less wealthy individuals until we reach down to the bottom of the highway, and at the very end, when nothing else was enough, then suddenly all these products were also made available to the public, and regular people were also able to buy investment funds, invest in real estate trusts, buy all kinds of insurances, get all kinds of financing that was earlier only available for those upper categories. So we see this is how it historically always worked, and this is what the Bitcoin advocates say is gonna be like. Is it maybe possible that these Bitcoin advocates were right, and in the future these little startups they created become strong exchanges? Is it possible that suddenly bigger high net worth customers, corporations, banks, and even exchanges get interested and involved? My personal opinion is that for that to happen, it would be necessary for Bitcoin to deliver some intrinsic value. It will have to generate a value that creates its own market, like mortgages, for example, whereby we know individuals were in need of loans to buy flats, houses. They were applying for mortgages. The bank decided that because it already lent out all the money they had, they would need to free up some assets to be able to continue lending. So what they invented, they packaged those loans as securitized loans, so to speak, and sold them either to other banks, to corporates, later to high wealth individuals, even get into pension saving programs of regular investors. The innovation started up here. Of course, it was fueled by a huge market down here. It's virtually always existent. And then this innovation first benefited everyone up here. Then it trickled down here. Then it trickled down here. Then it trickled down to the bottom. That's how it works, and it worked in the past. What we see here though is that we are inventing an investment asset, a Bitcoin, that is supposed to become more valuable, and all the arguments that are being brought up, why is it going to be so valuable, has to do with some Bitcoin halving and technical jargon about how the algorithm works. Has no single mentioning about any practical application in the real world, and therefore is questionable. If all these people are supposed to get involved, what are they gonna be doing with this Bitcoin? Let's say once in the future we will be able to pay for everything using just Bitcoin. That would justify the invention of all kinds of products, and would be probably a development in the direction of all kinds of derivatives, like we have options and futures for other currencies. But again, the demand would be rather of limited nature, of probably hedging nature. But it's quite possible. I mean, it's possible, but very unlikely, but possible. On the other hand, what could theoretically also be is that exchanges pick up Bitcoin. They would find a practical use for it. Banks will package products and start selling down the line again. If history is supposed to be of any indication, then probably the historical development would be more probable. However, we write a year 2020, and this year we saw, for the earlier mentioned reasons, the centralization of power as to who is able to influence money flow and value of currency, higher fees, the transaction speed, and other arguments brought up in favor of Bitcoin brought a lot of demand for Bitcoin. Maybe one more interesting reason why Bitcoin had such a big hype in the second and third quarter of 2020, as you know, we have a pandemic, and governments and regulators, to fight against it, what they decided is to exactly print all these goodies here, increase the supply of money that would be paid out to individuals, companies in the sectors of the economy to keep companies alive, and they were basically printing money which got distributed, which leads to high deficit. All these debts have to be paid back somehow, potentially again from the earnings of the very same people in the future. via taxes. And the very fact that we had a lots of dough printed leads to inflation. So every dollar, every euro or pound that's currently in a saving account is losing tremendously value. Another measure they came up with is to decrease interest rates. Maybe if interest rates are low, that would boost the economies that we had already before COVID-19. So very low interest rates, and stock exchange is risky. Of course, investment in stocks is speculative to a certain degree. In a very low interest rate regime, bonds and deposits do not cover even inflation, so people really started looking for other investment opportunities. One of them were stocks, and the other one was, as you guessed, Bitcoin and other cryptocurrencies. Both saw a huge increase. There is the arguments against all these government interventions that make people actually poorer in the long run, and therefore, as a protest, I would assume that probably not as much white collar, but a lot of blue collar individuals disillusioned by the current economic situation would have probably went into Bitcoin. And as long as these arguments hold, as long as we have very low interest rates, fluctuating stock exchange, rising inflation, which also indirectly leads to rising real estate prices, it's quite possible that to hedge themselves against losing purchasing power or potentially even getting richer is by letting Bitcoin appreciate and joining the ride. So this is definitely a trend, and who knows what we will see in the months coming, but if my assumptions are right, there will be a correction, and despite all the expectations about why the volume of available Bitcoins and the ones that are mined and this and that would lead to the increase of price, I'm pretty sure that the sell-off of Bitcoins would at the end bring it down again. Currently it's around 13,000 euros. Just a few weeks ago it was 11,000, so there you go. Definitely a large appreciation, and once that correction comes, we will know that the theory is confirmed. We will not see this upward spiral effect. We will basically see people who are here and of similar kind would go to their little exchanges, startups, trade between each other, convince families and friends to buy into Bitcoin, but it will probably never join the bigger economy, or just very slowly. But we might be wrong, and it's possible that at some point in the future, through the means of introducing Bitcoin as a valid currency for payments of all sorts and kinds in the real economy, there will be a bigger value subscribed to Bitcoin, and these guys up here, so I would actually assume that this direction is probably more possible. These guys will start treating Bitcoin as one of the other fiat currencies, will start selling and buying options against corporates who accepted Bitcoin payments from these guys here who had a lots of Bitcoins, and all those Bitcoins now are fluctuating just like other currencies. They need hedges, so futures and options will be provided for either by banks and institutions or by these little exchanges, which I would be surprised if real world participants would trust them that much. Really kind of speculative. We have already well established market players here. It's quite possible that real market participants, not the speculators but the real ones, would much sooner transact with financial intermediaries, and it's possible that this game at some point might, again, for the possibility of acquiring higher yields, again interest the high net worth individuals who will again start trading those futures and options for a commission with financial intermediaries. And if this product becomes fairly standard, it's possible that sometimes later in the future these derivative products also become available for the wide masses. Alright, that's the chain of thought on why Bitcoin is not the holy grail. Now, let's have a look at some of the examples we have here. This one is Ethereum, a platform that is also based on blockchain. What sets it apart from Bitcoin though is that this platform comes with algorithms that can be written by users. A so-called smart contract is how they call it, which can perform all kinds of actions, events, basically replacing the middleman. No longer required to have an intermediary, possibly reducing transaction costs as well, and also introducing the possibility to innovate and discover new products. So this platform has a big thumbs up from me for geeks and people who like to learn new stuff and are potentially interested in learning programming and development. Could look into the programming language that stands behind it. Thanks to Ethereum, we also saw the explosion of all those so-called shitcoins, pardon my French, those derivative coins that were basically possible to develop just because there is a platform, there is a programming language, there is an environment, and that led to this experimentation / innovation in the DeFi world. Here I would probably still want to mention one thing. Every single time someone invented something, as long as there was no open development access to it, it was a very difficult sell. There was Nintendo, Sega, and there was other game consoles who also had a developer kit and allowed individuals who were techie to create small programs and games that contributed to the popularity of these consoles. So they built an ecosystem that kind of fed itself. Then we had Android, the operating system, and Apple's OS. I don't know if you still remember mobile phones prior to operating systems existence. There were no apps. They were introduced basically by Apple. There is an app store where one can download millions of apps, and nowadays they can be developed on demand. There is a development environment, and if someone is techy enough, can learn how to develop these apps and can again profit from selling to these stores and also benefit from the size of the customer base. And again, these environments profit from the fact that there are independent developers who contribute. So it's an ecosystem, and in my opinion, this is what perpetually moves Android forward, and this is what Ethereum is about. It basically provided a new app developer kit, so to speak, and everyone who can program a little bit can go crazy and do something about it. Then we have another product registered under a startup called crypto.com, which is a debit card. They are offering a debit card. They are basically a so-called exchange, so again a website where someone can come and transact with CRO coins, as I understand. If one purchases their debit card, what actually happens every time this debit card is gonna be used, the CRO coins need to be first converted to dollars or euros before one could actually use the card. So again, a very nice gimmick for those who have sentimental value connected to all these crypto assets and all the freedom and the breakaway from the regulators and whatnot might actually find this interesting, but practically this is nothing else, just a debit card. It also works like a debit card. There is nothing invented here. This one was actually a pyramid scheme. BTC Rising is a little algorithm that probably a developer had a little fun developing, which allowed every new registered user to bring in more users under him, and they would have to pay in bitcoins that would be distributed to him, and they would again be paid out from other new members who would register under them, and there the pyramid goes. There is no value added. It's a pyramid game. Sorry for the low resolution image. It had to be because that's the only image I found. The website is already decommissioned. And then we have Lolly, which is again a product hanged on some kind of coin which is derived from Ethereum, and the product is nothing else, just a discount card. Yeah, we already have discount cards. If a user registers with Lolly and buys at merchants that actually have a contract with Lolly and pay with other cryptocurrencies, whatnot, they will get kickbacks. So it's just like any discount sale where we know how it works. The merchant up the price. There is a surcharge of 10%. Let's say with the discount I get a discount of 8%, I still lose 2%, and everyone else would anyways not go and shop in those stores because the prices are super inflated. So Lolly is again not a new idea, it's just a replica of something that already existed 20 years ago, if not 30 years ago. So there you go, these are the examples that still came into mind. Thanks for bearing with me. Everyone who watched to the very end deserves a big applause. A big applause, a big one, I said. A big. So thank you. And I enjoyed researching this topic, and maybe I will make some more videos of this kind. Let's see. Hope to see you in the next one. Bye bye.